Now too.
Okay, hello everybody. I'm going to start with our option pit disclosure. The materials presented for you are from Option Pit, are for your informational educational purposes only. They are not legal or tax advice. We're not responsible for any losses that occur from the transactions, which you might do from these ideas. Also, to the extent that you use concepts in this presentation material, ask your financial advisor, legal or tax advice, or anything like that. And for now, put your survival hat on. Actually, I think I have one. I've got one. There you go. This is going to be the Market Survival Summit. I've got my survival hat on just because things have been so crazy. But we are going to address some things for you here today. You should be able to walk away with a couple of really good ideas on how to trade this market. And if not, we've got answers for that too. All right. So first is we're on S&P 500 is on a historically bad run, at least since 2020. And that one actually started to come back relatively fast. Inflation is at 40-year highs. Again, that's something that as a trader, I've been trading options for 30 years, since 1991. First as a floor trader. Then I owned my own trading business for a while. Then I retired, got into venture capital, and then found Mark eventually, because frankly, trading was easier than everything else. So I've been with Mark at Option Pit for 10 years, and I'm the director of education there. So that is a little bit of my background. I've been around the block for a little while. So right now, we're in a bear market, quote unquote. CNBC says so, so it must be true. And to be quite honest, I think it's only going to get worse. So what I'm going to show you today is my favorite system that I have been doing with my pro traders at Option Pit probably for 8 years. And this is the first time we've actually put it out to the public in general. And the reason why is because that's what we have. I mean, we have a market that's kind of unhinged, and we're into uncharted territory, quite frankly. So I think this system works the best for this kind of trade, and I'm going to show you what it is. So just strap back and sit back, strap on, and be ready. Okay, so first, we're going to go over the problem that you're trying to solve currently. Probably mostly it's just, it can be tiresome just walking in and, market's down. The ETF to trade right now and why. The exact time to make your trade each week and why I do it a certain way. And the chart that pays for your trade. So there will be some chart analysis here, but probably not what you're used to. And then lastly, how you can get started in this big adventure. So as we go through these things, we're going to we start with our problem, and then we're going to solve the problem as we go down the list. Okay. Now, the thing that we're trying to do, right, is this is the first bear market probably a lot of new traders have had, since if they started in 2020, they don't even know what a bear market is, right? They start at the bottom, and we literally went straight up for 2,000 SPX points. I've been through 3 or 4 pretty good bear markets. I first walked onto a trading floor in 1989, and I walked off in 2006 when I wanted to. So it was I had a great run before Citadel wrecked it, but nonetheless, it was a great time. But if you're new to trading, this is your first bear market ever where you just walk in and things are just down, down, down. So if you're walking in and just, your account's always down because you're always long, that's what we're here to help for. We're here to help solve those problems and give you the flexibility in order to trade another way. So you don't always have to be dependent on being long. What we're introducing is our new product called Option Pit Spy Master. And I'm going to walk through the steps that make Spy Master work in this market and show you examples of trades working. So, and how to deal and manage in this marketplace. So Spy Master is the Option Pit product that I manage for Option Pit currently. Now, first, let's start with the SPY. If you're not familiar with it, I just want to mention it, right? It is the ETF that tracks the S&P 500. And as some of you might know, it's weighted heavily toward Apple, Microsoft, Amazon, Google, and Tesla right now. Actually, the 25% of it is heavily weighted toward tech. If you wouldn't know it from just looking at the SPY right now, besides Berkshire, Johnson & Johnson, United Healthcare, and Exxon, much of the S&P 500 is actually trading at a very reasonable multiple. Even Exxon is, Johnson & Johnson is, United Healthcare is, even Berkshire, right? It's the tech, it's multiple in tech that had such a massive expansion. That's really been the trouble, especially the last, in 2022. But it is very liquid, okay? 416 billion in assets. So it's a massive product. And the liquidity when I'm launching a product at Option Pit, I've launched, I don't know, a dozen or 2 dozen over the years. I want liquidity and my students to be able to trade the product. So SPY obviously fits the bill on that score. Another thing too is understanding liquidity in markets. So SPY has very liquid option markets. Even when things were going to heck in 2020, there was still decent liquidity in SPY options. Like you can get an out of 10, 20, 30, 40 lots, whatever. It still could be done. So they're easy to trade. So, part of creating a product for my students is you need something flexible. And it also has to be relatively predictable. SPY has an 80% negative correlation to the VIX. And I'm going to get into that. So what you do notice here with SPY markets are they're only about 5 to 7 cents wide. So you're not paying a lot of slippage penalty for getting in and out, which makes it a lot easier if you're going to execute trades that have shorter time frames. Most of the SPY Master ideas, I'm expecting like a 2-week time frame on them. So, getting in and out of a trade is important, and you want to have a liquid market so you can do that. But one thing, again, we want to touch on here is the negative correlation for SPY to VIX. And I'm going to explain what that is for you right here. So, okay, the VIX and the S&P 500, the SPX, are negatively correlated, about 80% negative correlation. Okay, so what that means is that when the VIX is going up, the SPX usually goes down. When I say usually, 80% of the time. So you could even look today, market's up quite a bit, and VIX is down a little bit. Now there's reasons about that. I explained it in SPY Master, but you do have the correlation going. So you have the pop in SPX and you have the drop in VIX. Now, since the SPY is 1/10 the SPX, it's basically the SPX. So the SPY and the VIX options are also negatively correlated. So this is one of the first, what I would call pieces of intel, and I don't think I need these right now. I don't need them. Is you have, right? You have this negative correlation that exists, and it's a tradable thing. All right. Now, again, just keep an eye on this. So the next 5 or 6 slides or so will be a little bit more into the weeds of VIX and SPY and so how they work together. So you might want a pencil or something and write some of the things down if VIX is new to you. VIX SPY correlation is new to you. There'll be some things in here that I think that are useful that you might want to write down and pay attention to. All right, so what do we have right now? We have the SPY here on the top chart. Again, notice here you get those little red candles there moving down in SPY, and then boom, you're starting to get spike in VIX. Then here we go, SPY literally falling off the face of the earth, and VIX running to the moon like Mount Everest, right? Then you have a little bit of relaxation in SPY, everything starts to chill, right? VIX comes down very, very fast. So one of the things you notice is when SPY starts to settle down, VIX can move very, very fast on the way down. So you have slightly different speeds, right? Now here is SPY staying still, and then it's starting to just break again, and VIX is taking more of the, the steadier step up, but still climbing. So what you can see is, one of these products is heading down while the other product's heading up, or SPY might be heading up and VIX heads down. When you have basically kind of a solid bounce. If you guys remember, this is when everybody thought everything was going to be totally cool. And we actually were looking like we get back to the highs of 2020, right? And everything just sort of stopped, right? And this is what's great about this product. When VIX stops going down and the SPY, right? And then you don't get any kind of move out of the SPY. Sometimes a stop in the drop in VIX is a good tell for a top in SPY or SPX. So part of this, or part of the negative correlation, is also helping set up the type of trades that you want to be long SPY or short SPY. So in this particular case, you can see though, SPY going down again, VIX going up again. Then again, we started to have these huge candles, and then VIX started spiking once again as things got kind of nasty last month in May. And then finally, we had basically our waterfall here with the recession coming, or the market's pricing like the recession's coming, and then VIX straight up, like literally boom, straight up from a 24 low all the way to a 34. So you get that really sharp pop on the upside. So this is a tale of the two products, right? SPY and VIX, and a representation of how they negatively correlate to each other. And it's a very strong negative correlation. Since this correlation does happen 80% of the time, if you're long VIX and long SPY, right, like a long trade, one side will almost always win. That's important. So if you have one side winning a lot and one side losing a little, you have the potential for a breakout type of trade where you don't have to take a ton of market risk for a period of time. So when you're setting up a trade like that, that's one of the big relationships I look for is, will a long VIX and a long SPY trade work out for a breakout trade? Like right now, we could have one, right? Because we do have a SPY going up and VIX is coming in a little bit. So yeah, a breakout trade is certainly possible. But what I did was I did a back test on the concept because I want to just sort of see how it worked. And so here's an example from just 2021. And I'll read the columns for you. So the top tick column just means what? If you just bought a VIX call spread on expiration day, right? VIX expiration. You had a sorry about if you bought a VIX call spread at expiration, okay, every Wednesday. Oh, stop Lydia. Thanks, sorry about that. Come on, hurry. my dog just popped into the room, but it's back now. All right, let's start over again. All right, so every expiration, you bought a VIX call spread just on expiration day. If you held that VIX call spread to the end of expiration, if you were able to top tick the call spread, let's say the average price was $1.30. If you did in August, you would have made 170 on the spread. If you could pick the top tick on the spread. If you just close it at the end of the day on a spike in VIX, you would have made 30 on that spread. If you go down to August of 2021, again, the top tick on the spread was 120. If you just did an end of day close on a pop in VIX, you made $10 on the spread. Again, October, the top tick on just, again, buying a call spread, and these are about $1.30. The call spreads average about $1.30 on expiration day. And then on an end of day close on the October case, you make 135. So if you add it all up, so this was amazing because I never back tested this strategy. It just seems to work. But if you would have bought a VIX call spread in 2021, which was a volatile year, but not a hugely volatile year, right? That would return $1,700 by the end of the year. That was a crazy number to me. Because remember, you're only buying one spread at a time. So you're only risking $130 per month, every month. And the return was pretty enormous, actually. If you just did the end of day close for a VIX call spread. It returned $600 on risk. Now, 2021 was a pretty seminal year for SPY, and I chose a simple SPY test. So if you just sold a SPY credit spread, so this is a $10 credit spread with $1,000 of risk. Again, here are the credit spread premiums you pulled in. In 2021, you would have pulled in a premium every single month. So 60, 120, 90. So when you get to, well, you add it all up by the end of the year, you would get 100% return on risk. So the credit spread strategy in SPY in a really good year, it was still a great return. Everything went straight up, granted, but it was still a good return. The top tick return on risk is if you could sell the top of the VIX spike. So that's the value of the VIX call spread at the top of the spike. So if you were super awesome and picked the top every time, that would be your return on risk. So it was pretty enormous. So those are giving you the top tick prices. So you could see you're doing 100%, 200% almost on your VIX call spreads. So part of this back test, the long VIX, long SPY, it tested very well, which I knew it would, but I was surprised in 2021 that it was making money in VIX call spreads was as easy as it was. But that's I thought one of the most important data points. Credit spread trading is a credit spread. So nothing, I don't think there's anything really new under the sun on that one. But being long VIX and long SPY, that's a natural hedge, right? Your VIX spread, $10 spread is hedging your 5% out of the money or 10% out of the money SPY put spread. So from that point of view, the back test worked pretty well on the breakout trade. So the second is, again, this is another point where you want to pay attention because there is more gold, right, to be found in this type of trading style. So remember, it's a style where you're using a VIX component and a SPY component, right? So the VIX curve actually gives you a little bit more, and I'll explain it a little bit here. All right. So the first thing is VIX doesn't trade, right? Or VIX options do not price off of VIX cash. So the index you see by CNBC when they say the fear index and all that stuff, they're saying VIX cash. That's not what the options price off of. All right. The options price off all of the futures, just like they do in a commodity future, treasury future, Eurodollar future, any other product with the future. Traders price the options off the future because that's the liquid product that trades. Okay. So that part leaves us with a curve, right, that you see here, the blue curve in this picture, that is farther away from the cash price. So the part of the curve that's advantageous for us is volatility is priced more expensive in the future than it is right now. It's kind of like buying one-day insurance or buying 6-month insurance. So the advantage for us is it gives us an opportunity to trade that curve reverting to the cash. And that's the cool part. So what happens is because those futures are higher than the cash, when we're in that condition, VIX puts price relatively inexpensively. All right. So in this case, the curve the curve versus VIX is giving us a roadmap where things are going, right? Because the futures gravitate toward the cash. It's like, I call it a gravitational force. So as the futures move from up, right, and they're moving toward the cash at expiration, because the only time the future and the cash or the options are looking at the same price is on expiration day every Wednesday, when VIX futures settles into the cash. So you always have a bit of a roadmap, right, where the futures are heading every day. Sometimes the signal's great, sometimes the signal's a little weak, but you do have that roadmap, which makes it a lot easier to set up a trade. Okay. So here's an example of what we call contango, right? That is the VIX future curve is the blue line. You got 2110, 2326, 2442, right? All the way here, right down the line, okay? And as time goes on, those futures are decaying to the cash. So this is just like option decay. You can think of it like that. If you've ever sold options and watched them decay, futures actually do the same thing. Again, over time, time is eroding that time. Time is eroding the value or the premium of that future over. So in this particular case, the direction is down. So anytime you see a down direction in anything, right, you want to buy puts, right? So if you think the direction is down, you want to buy puts. So this sets up a long VIX put side of the trade. Here you've got the opposite condition, and which is what a lot of 2022, quite frankly, has been. You have the VIX cash here at a 34, and beneath it you have the futures trading at a lower price to the cash. So if you're looking at this, which direction is gravity going? So in this particular case, it's more like space, where gravity, I wouldn't say there's no gravity in space, but here the gravitational force is up. It's not down like normal. So anytime you see the gravitational force going up, that means the futures, the underlying price is cheaper than the cash price. And you could go do an experiment, okay? Go to any option that trades besides VIX, right? And look for an option that if you held the underlying constant, you would make money on that option trade. There's almost no option you could find trading right now where that phenomenon can happen. The only place that it happens with any reliability is in the VIX options because of the VIX future. So the unique thing about trading VIX and why the strategy works and why it's worth learning is you will have times when the futures like this are much less than the cash, and it brings an opportunity to buy calls in the VIX. All right. So it gives you what we'll just call a little head start on your trade. So what I'm looking for most trades is some kind of an edge. I want some kind of a head start that the market is giving me, and then I manage the trade from that point. So in this particular case, you can see that the futures are lower than the cash, and as time goes on, right, they are moving up toward the cash price. Now, here is, again, remember I told you to have your pencils out because there's going to be a little curve geekiness here. So in this particular case, what's going on? You have how the whole VIX futures curve moves at once. So you have the purple curve, let's say, is day one, and the blue curve is day two, right? Again, you can see a dramatic drop in that future price. So if the futures are dropping dramatically, that means the value of puts should be going up. So generally how VIX works, or how the curve works, is the VIX volatility curve moves in such a way that as VIX cash moves around, we have that kind of shock move down, the futures curve all gets pulled with it. So here, this is an illustration of giving you an idea about sort of how that gravitational force can work over time. So part of the strategy is looking and seeing when that's going to happen. All right. Now, here is important thing about the lag. So the lag between the two is important because if you're not right on one part of the trade, you have time to be right on the other part of the trade. That's what makes it so flexible as a trading strategy, because you're not totally committed to either having the SPY move a bunch or the VIX move a bunch right at the beginning, right? Time helps things move. So if you see here, so this is a chart of the SPY. So all the candles are the SPY chart. Okay. And here the lines are the performance of VIX. So you can see this one line here, peak to trough. VIX dropped, the value of VIX here is dropping 36% of the value. I know it's a percent of a percent, but the value of VIX basically was cut in third, right? Then it spends a little time going up and then again shoots up again a huge amount, picking up about 1/3 of the value. Okay, so that would be like a VIX going from 20 to 26 or 27. Then it beats around a little bit, then has again one more sharp spike as you have an accompanying sharp sell-off in SPY. And then SPY tends to just move back and forth here, and you have a little bit of movement with VIX. But as SPY even stays constant or relatively constant over time, you can see like a peak to trough, you have a big drop in the value of VIX. So what it does is this time lag gives an opportunity for the VIX part of the trade to generate a few extra bucks, right? Because you can stay in the volatility part of the trade for quite a while. Again, remember, from the future curve, you have those futures gravitating toward the cash. And if you're on, and as you set the trade up, you're getting on the right side of that gravitational force, right? Again, survival technique for the market. Now, this is the part that I think is the most fun for the strategy, right? Where the best potential gains can be. So here you have this was April 4th snap taken, where you have what I would call is a really healthy contango, right? Where the futures were very far above the VIX cash. So the VIX cash is 1857. I believe this is the low print of the last 3 months or 4 months, if I'm not mistaken. I'm pretty sure. It might even be the low tick of the year so far. But VIX cash was 1857. And you notice how all these futures were way, way, way above the cash number. So they have a long way to go down. Okay. But that also means that VIX puts are relatively inexpensive. And that sets up trade number 2, which is short VIX, short SPY. And I do that by buying puts, a put in each. Buy a VIX put, buy a SPY put. Now, how this works is the edge comes from the fact that your VIX put is relatively inexpensive, right? Because the underlying price is higher, if you just think about it, right? If you're buying puts in, let's say Apple, right? And the price of Apple keeps going up, your puts will be cheaper, right? Because as Apple goes up, put values go down, and VIX is no different. So as the curve is more expensive than the cash, when you have a lot of premium in that future, that makes the VIX put relatively inexpensive. Okay. So you have a head start on the value right from the get-go. Now here's the part that's the most interesting. So here is what the VIX curve look like, right? Again, you're looking for gravity to pull VIX down. But what happens on the other side, literally on April 5th, 6th, 7th, all the way, we started basically a 5-week down move in VIX or in SPY from 460 to, 400? I don't remember exactly what the low tick here was, but let's call it like 410. But literally a 3-week period, almost a 1-month period where SPY was all except for a couple of crazy bull market rallies straight down. Right? So this is where short SPY and short VIX works as a trade. So if you think about it, now we have 2 trade types, and which is what I promised you at the beginning. There's a long VIX, long SPY trade type, and a short SPY, short VIX trade type. But neither of these trades are necessarily market dependent, meaning the market can be up one day or down one day. And you have a part of the trade that should be working. So this is an example here, though, of when is a good time where you want to buy that VIX put, but buy a SPY put with it. Now, this is a trade just from Option Pit. Like I said, I've been doing these trades with my pro students for about 8 years. And this was just in one of our products. Oh, I'm sorry, not this one. This is what I would call a perfect trade, excuse me, where we were into the trade idea for 665. I was into the trade idea for 665. It was a June 8 entry date. Again, here's the curve. You had that very high contango with VIX cash below. The total cost of my, it was the June 2026 put, I think it was about $2.80. And the cost of the 395 SPY put, it was the June 29 395 put, was about $3.80. So net, the cost of both puts was 665. In 6 days, it doesn't always work like this. This is why I'm calling a perfect example, where literally just the market, went down 10%. It was ridiculous. So from a dollar point of view, that would have returned, you're out of the trade for $2,100, a little almost $2,200. Now the thing here in this case was your SPY put went to almost $20, a little over $20, but the VIX put was cut in half. It went from basically 280 to 135. So from a trade point of view, even then your VIX puts don't necessarily just go to zero. In this particular case, but the SPY put had a ridiculous outperformance. So this is when the strategy, I would say, works perfectly, where you put the trade on and you get literally an almost instant drop in the market, and it's great, no complaints about it. Now here is an example of just in one of our trading products. It wasn't perfect, but it worked fairly well. So on May 11th, I bought a SPY 375 put. That's our short market side. And here it was right around, I believe, this area on the 11th. So right here. And I also bought a VIX June 27 put. That's the long market side. So again, SPY put short market side, VIX put long market side. And the idea, I thought, was VIX was looking a little toppy and SPY was a little weak, but we also had, again, another contango curve set up at the same time. And then SPY proceeded to drop relatively fast, and I was able to close the SPY put and the VIX put and gain 26%. That was a one-day trade. It didn't have a 6-day market down 10%. I only had about 1.5% out of the SPY. But it was enough to take the trade off for a decent price. So for this strategy and how it works, those are the type of things that I'm looking for, right? I'm looking for contango on the curve. I'm looking for good prices for both my VIX put and SPY puts, and to set up the type of trade. Okay. Now, these are what I would call 3 steps to making the trade work. I try to make it simple, but it's the signal that's more important when things look good. So I'm going to pick either VIX puts or VIX calls first, based on the type of trade, the type of curve that I see. So the VIX put or the VIX call is my financing mechanism. I'm using the volatility product to finance all or part of my SPY puts or calls. All right, and then I want to let time work the VIX part out. The second part is finding a SPY put or call that will pair relatively well with the VIX trade. So again, that's part of what I do at SPY Master. That's what I do, is looking for that type of option to get the trade set up. So the dollars match up pretty well and the performance matchups pretty well. And the last part is I close or hold each side depending on how the market moves. So, SPY falls apart, I'll close the SPY put. Or if the SPY rips, I'll close the SPY call spreads. or we have a big move in VIX, my tendency is to close the SPY when it makes me money and try to hold on to the VIX side as long as I can to get the full curve to kick in and make money. But you never know where the market's going to go, which is one of the best things about the strategy. So it gives you a long side and a short side to the market. All right. So now I want to go into like the trade outcomes. You have a long SPY, long VIX trade. So that is more for a breakout strategy, which quite frankly is kind of how this market is, where, say the SPY is selling off, things look ugly, and you want to find a way to be long without having total overnight exposure, is the easiest way I can think about it. Because if we do get that next leg down, that's generally when VIX starts to, take out new highs. We haven't really gotten that huge leg down yet, past the previous lows, but we might get that one of these days. The second type of trade, remember, is the short SPY, short VIX. This is what I would call the fade trade, meaning, and it's a trade that a lot of liquidity providers have been using for, I don't know, probably since they started trading options, right? So the unique part of the strategy is you can fade the market and fade volatility, but you don't have to sell options. You could buy a put in the SPY to fade the SPY trade, or fade the SPY direction, and you can buy a VIX put to fade the volatility direction. So if you think about it, if you have a market that's just rallied hard and it's starting to settle somewhat, right? Meaning the candles aren't as big, the market's not moving as much. So being short SPY and short VIX is a good thing, is like that vol contracts, right? You're looking kind of for that, like I said, that contraction or fade trade. And it works very well that way. In general, though, I expect to make money from the SPY side. So, and the reason why is SPY will always produce the fastest money. VIX produces the eventual money, what I would call VIX to the rescue trade. All right. So when you're looking at setting up a trade, you're also thinking about, okay, what's the outcome or the end of the trade, or how it's going to look. So setting up this as a strategy, you very much want to have the type of trade in your mind, before you put it on. So that's why I separate the two, as one is a breakout, which is very much a different type of trade than a fade. All right. But lastly, the important thing is that VIX comes to the rescue. All right. Now, if you want to use this strategy, this is how I try to set it up. Okay. So if you want to be a true SPY master, wear your survival hat, right? Be ready for whatever the market has to throw at you. Again, there aren't many strategies that you use the VIX to produce edge in your trade, and you also have a long short strategy set up at the same time. So this is a smaller capital allocation with huge potential returns over the year. So the strategy works with just $300 to $400 per trade. So you don't have to spend a ton of money on your SPY puts, and you don't have to spend a ton of money on your VIX puts, right? That's part of what helps set the trade up. Okay. Why I do trades on Wednesdays. And the reason why is VIX settles every Wednesday, and it gives you the longest cycle for VIX for the week. So the Wednesday cycle gives you basically the full cycle. Now, the whole idea of this strategy is time is doing the work. So you are letting time push volatility up or down, depending on how you start the trade up, depending on how the force of gravity sort of is working on the trade. So if the vol direction is not going to work, then the SPY direction should. Okay. Another thing that's interesting about the strategy, or what's great about the strategy, is there is some action, meaning you buy a VIX put or a VIX call, you're going to close it. Or you buy a SPY call or a put, you're going to close it, right? So it's not a strategy where, like if you have some kind of credit strategy where you might have to take delivery or something like that, there's nothing involved like that. It's you buy the product, buy the option, you sell it when you have the move. Okay. So it's not, but it's not a huge time commitment. So what I generally use is just good till cancel orders. If things are getting close or not happening, boom, that's when I put the trade out and send out an alert to my students. So it's a fairly simple system. There's moving parts, but it's not overly, you don't have to be a market watcher all the time. So lastly here is what I would call a code green. So, and we almost have one today actually, right as the product's starting. If we see the need to deviate from our Wednesday trade, I let my students know, meaning the edge, there's better edge in the trade if we do it today. So I'll send a note out, set the trade up, and put the alert out to my students. And sometimes that happens, right? You get a very severe market move, right? So if you think about it, it's like the rubber band. Sometimes the rubber band might stretch really early, and that's when I want to take advantage of it. So before I get into this, there's just one question. What duration of the options you use? I would say, Frank, it depends. So it depends on price, what the curve looks like, but I'll rarely do anything longer than 30 days. Like all the action in VIX is 30 days. I send trades via text alert and email, right? So it's only one trade a week. So it's more important to do one good trade a week and make sure that you get everything, have the ability to exit the trade. So it's usually one trade a week because of the way vol works. I think the capital required, I just said, is like 300 to 400 per trade. So remember, it's a one trade per week strategy, all long options, generally long spread strategy. Okay, so this is actually the product. Okay. Again, we have weekly SPY and VIX trades. They're delivered every Wednesday, unless we do the code green, and they're delivered via text and email. You can trade it with cash options accounts. You do not need a margin account. You do not need a margin account. The whole purpose of the strategy was non-margin. I have students that take the strategy and do other things with it, right? Create margin strategies, but I stick to this product. It's just simple, straight calls, puts, straight call and put spreads. But my students that I've had for a long time, they do stuff and they change it around a little bit, but that's how it suits them. So we do have a class every 30 minutes on Wednesday at 3 o'clock. So we do talk about the strategy, the curve setup, try to optimize the trade and explain what's going on, the expected decay that I'm looking for in the trade to pay for it, all of the things that go into making the trade, and the management routine. Also, I put the management routine in the email that I send out. Last is you get just a training series on VIX Made Easy. It's Option Pit's most popular. It's the thing we've sold the most. So that's a lot of people coming. Just can you just show me how VIX works? And then we go, here's a video series we made on it. It's a 5-part series, and it goes into all of the stuff. You know, how the curve works, settlement expiration, the skew in VIX, all of the little weirdness and quirks in VIX. Nothing more than 30 days is the duration for my trades. Because when you're trading VIX, most of the action is within 30 days. The least term probably I would say is 2 weeks. Because you need a little time for vol to work itself out. Spy Master Mission Dossier, which I'm writing right now, to be honest. This is just basically, it's kind of a how-to. We're going to implement the strategy. And you do have a members only portal page, so all the trades will be there, class times, all the videos, so you'll have like a library of how to manage the trades. VIX Made Easy will be on that page. And also if you have questions, so we have during market hours, we have somebody on the phone, 888-TRADE-01. And he will answer any question. Win accuracy, I haven't put together this strategy, Joan, to give you an accurate number. So I couldn't tell you, to be quite honest. I know I've been teaching it to my pro students for the last 8 years. So this is the first time I've actually sent it as a product. So I have my other vol strategies about 65% wins. Is there any website recordings on your site? You mean new recordings or old recordings? So for this product, there isn't anything yet because we haven't launched it yet. We started it. We started introducing it on Wednesday, and the sales for it closes tomorrow at 4 o'clock, 3 o'clock Eastern time. So on our website in general, we have, depending on what product you have, I mean, we have thousands of videos on. But there will be a video of this. So yeah, this is a brand new product, Joan, just to answer your question. It's the first time I've actually launched it together with SPY and VIX together as one product. The thing I showed you the test before is just what a long SPY and a long VIX can do on the back test we did for 2021. All right. Here's the cost of the product for 1 year. Whoop. Again, you get a lot of stuff every week. It's $9.97 annual and $19.97 lifetime. When do I expect to upload videos for this new product? There only will be videos available for people that are members, Bobby. So there won't be videos of how we do things unless you're a member. We do have other stuff that you can buy or look at, but we won't be going, this product will be behind the paywall. Like everything about it, all the entries, exits, everything. There won't be anything publicly available. The only thing that is available is VIX Made Easy. The VIX cash is not traded in the future market, Lawrence, but the futures are. The VIX futures are traded and basically on the CFE, which is the CBOE's future market. So remember, the VIX settles to cash, doesn't settle to futures. And this gives you an idea. So it's $9.97 annual, $19.97 lifetime. We did give our students a guarantee. You pay, if you don't pay for your membership in the first quarter, you get another year for free. So if you call Ted, if you're interested and say you saw this presentation today, I would just offer that to you guys until we close tomorrow at 3 o'clock. The idea is, and I'm trading all the same trades. So when you see the alert go out, I will be putting on the exact same trade. And then we see how we do. It's exciting. Is there any trail offer? I'm not sure what that means, Bobby. Trial offer. There is not a trial offer. If you do buy it and you don't like it, you can return it, 2-week money back guarantee. So we really don't do trials. We just give you your money back. We don't have a lot of returns, but people aren't happy and they want to switch it, they can. But you get a 2-week money back guarantee. It's not bad. But again, like I said, the guarantee for this is yet you would get a year if we don't pay it in 1 quarter, because the way it's set up, right? I want 1 or 2 trades to be able to pay for the annual membership, right? We get a little bit of a pullback in the market, right? Or we get a pop and SPY, one of the two. It should generate some bucks. Anybody have any other questions? Because I only got a couple more minutes. You can go to the Option Pit website, optionpit.com, and there's a pop-up there to order it. The product will be closed on Wednesday. Oh, thank you, David. At 3 o'clock Eastern time. So you won't be able to buy it anymore. So we had a good response already. So it's the right thing for the market that we have. But at least you have an idea of how to go about setting the trades up going forward. So hopefully this was a good use of your time. I don't wear my survival hat very often, but when I do, you know, it's a big deal, I guess. Any other questions? Can we pay in installments? Yes. Yes, you can, Bobby. If you call Ted 888-TRADE-01, here, I'll put this in the message. 888. Just call Ted, say you saw this presentation. Oh, yeah, there you go. How about that? There's more info at optionpit.com or 888-TRADE-01. Yes. So that price is still good until 3 o'clock tomorrow. Any other questions? And then after the first quarter, I'll probably do another one of these and see how we did. And I think it'll go well. Actually, I'm sure it's going to go well. Well, with little delta, 90% sure it's going to go well. Anything else? All right, probably next time you'll have Mark. If you have any questions, though, about Option Pit products, again, 888-TRADE-01, or send me a note, Andrew@optionpit.com. I check my email maybe once a day at the end of the day, but I do answer people's questions. So, all right, everybody, thank you very much. I think that's about it.